The Morphic Global Opportunities Fund was down 1.5% for the half, which is slightly disappointing against an essentially flat global equities market. The major reasons we underperformed for the half were give back on previously successful trades. I'm going to identify three. One was China, which, as we all know, had a sharp turn down, and we got stopped out of that. India, we'd made a lot of money from, got stopped out of that one as well. And lastly, US healthcare stocks, which have been very profitable for us in the first half, got hit quite badly at one point, and we've shrunk that exposure and started to regrow it. We were very encouraged that we made so much money over the half from long short positions where we were market neutral, so we had no cash exposure, and they were primarily in US banks, 2 trades we had on there, and also in global funds managers. And we also made some money from things like our last part of our Japanese drugstore trade, a long short trade where we were long Recall and short Iron Mountain. Those were all very good trades for us, and we like them because they're the kind of trades that we think will do very well in a essentially flat or choppy market in the next couple of years that we expect.
Yeah, at the moment it's quite easy to say it's all over. But on the other side of things is, I'd say what we can define though a little bit more easily is we're near the end of a bull market. And what are some of the characteristics of what the end of a bull market looks like? Okay, the first thing is you see a big divergence. So the initial stages of a bull market is everything goes up. In the middle phases, lots of stuff keeps going up, and at the end a very narrow subset goes up. And each cycle is different. So in 2007 it was commodity stocks, in 2000 it was in-net stocks. This time around you're seeing these quasi-in-net stocks, whether it be Amazon or the Facebooks, have kept leadership going as the rest of the market slipped away. So that's usually a very good indicator of being late in the bull market. It doesn't tell you exactly which part of the end you are, but it says you're late. The second part is M&A. Companies are traditionally very pro-cyclical. They tend to do no M&A at the bottom of the cycle and do most of their M&A at the top of the cycle. So M&A last year was up quite substantially on 2014. We don't know yet how it's going to go this year, but directionally it tells you that these guys usually are not the best at timing where to go in the cycle. Thirdly, now we've got the Fed actually moving. So markets generally don't roll over properly until the Fed's actually been hiking interest rates. So up until December we had no evidence the Fed had hiked. Now we have some evidence. We arguably, even at the very least, you probably see 2 more rate increases this year. What we don't know is how many rate increases they need, but it says that we're towards the end of this.
I think the biggest opportunity at the moment is going to be trying to pick the eyes out of the market through long short trades. That's a capacity we have that many other managers of the market don't have, and we think that we are quite good at that. We've got a number of areas, we've done a lot of work on it over the years. The other opportunity for us is going to be to manage our net exposure to the market well. And the third is the more traditional buying of very good opportunities in the marketplace and holding those stocks through thick and thin. That's another, obviously very tried and tested way of making money through the cycle, and to be committed to buying some very high quality businesses when they're at relatively bargain basement prices.